In bull markets, no one really talks about dividends. It's all about high growth stocks, the next 10 bagger, tech stocks flying by 300% in a year. What happens when the music stops and volatility hits and your portfolio takes a 20 to 30% haircut like we just seen in recent times? Well, even in such times, dividend investors are still getting paid. And that's why in this video, we're going to be talking about dividend investing. Why dividend investing still matters, the psychology behind it, the pros and the real risks. And I'm also going to show you a real case scenario on a free dividend calculator that you can use for yourself to run your own numbers and see whether it might be worth it for you. And finally, I'll be sharing my personal experience as I used to invest in dividends before. So, do I still believe in dividends? Or am I even planning to come back to the strategy? In this video, I'll tell you where I stand on this. But first off, a quick reminder what dividends really are. In simple terms, it's a company sharing parts of the profits with you, the investor. Not reinvesting the profits, not buying back shares. Instead, it's just taking the cash and paying it out to its shareholders. Dividend stocks reward long-term holders. They encourage ownership, not speculation. And it's a totally different mindset from chasing the next moonshot idea or next meme stock company out there, especially when the market's uncertain. Like the times we're in now, dividends can really provide a sense of peace. Cash flow coming into you regularly, predictably. So even when the market is down by 20%, you might still be collecting a 4% dividend yield. That income can be reinvested, it could be saved, or of course, you could just use that income to pay for your regular living expenses. So let's take a hypothetical example. Imagine you're 64-year-old, about to retire, depending on which country you're living in. We might be even older by the time we reach that. But let's assume at the point when you want to retire, the market's actually down in the correction by 25%. And you're planning to withdraw from your portfolio, right? Because previously you invested in companies that grow for total returns, not for dividends. Now, what you gonna do about it? If you're selling your assets at a loss to cover the rent and groceries, well, that will definitely hurt, right? You don't want to be selling when the markets are down. And even worse, by doing so, you're actually reducing your compounding engine, right? Because dividends are compounding year after year. But that way, they won't because you're selling at a loss. But on the flip side, if you had a dividend portfolio and that portfolio was yielding around 3.5 to 4% net dividend returns, well, suddenly you would have a cash flow without needing to sell anything. And that's really powerful and why a lot of people are liking the idea of dividend investing. You're basically preserving your capital while still meeting your income needs. And that's really where dividend investing shines. Let's talk about quality, because not all dividend stocks are actually equal. There's some very special companies that we call dividend aristocrats. These are companies that have increased their dividends for 25 consecutive years or more. And then there's the next level, the highest level technically of dividend companies, which we call dividend kings. They have actually paid and increased their dividends for more than 50 years. That's decades of paying and growing dividends through recessions, wars, tech bubbles, and pandemics. This is really incredible. One of the most iconic out of all of them has to be Coca-Cola, which is even loved by one of the greatest investors in the world, Warren Buffett. He himself invested around 1.3 billion in Coca-Cola shares back in the late 80s. And today, that earns him over $700 million of dividend income per year from that position alone. That's over 50% annual yield based on the original cost. That's what time and dividend growth can do. So if I head over to Seeking Alpha over here, you can see the dividend summary. Right now, they're paying a dividend of around 2.86%. So that's an annual payout per share of $2. So if you had one share in a year, you would earn $2 from it. And right now, a share costs you around $71. The payout ratio is 67%, which is something to keep in mind and an important number because basically it means how much of their profits they dedicate towards the payout. If it's 100%, that means all of their profits go towards the dividend, which is obviously not a good thing because you still want to have some money in reserves or to be reinvested into growth and development and so forth. So 67 is on the healthy side. Anything over 90%, unless it's a really special case like REITs and so forth, I'll be a bit more cautious. And then you see over here the 5-year growth rate. So it means every single year over a 5-year period, they've been growing that dividend by 4.07%. Now, obviously, that could be higher. Some companies I've seen over 10% even. That means that number, the $2 in 10 years, will be much more than $2, right? It might be closer to $3 over time. And as you've seen before, as it is the dividend king, they have been growing and paying the dividend for over 62 years now, which is really outstanding. And we also have the dividend estimates for the coming years, where in the future they might say it might even go all the way to 3%. And you see obviously how that would impact the actual payout. The real dollar amount will be increasing for the next few years as well. And the dividend is being paid out on a quarterly basis. So you can see the last payout was 51 cents for that quarter. But if I go back, not so long ago to let's say, 2015, it was only 33 cents. So it almost doubled in value from 33 cents to now 51 cents. So you can see really how the dividend growth over time has an impact on your returns as an investor into the company. So this kind of track record doesn't guarantee future results, but it tells a story of consistency, resilience, and of course, shareholder focus. This is what investors look for when building a dividend portfolio. And of course, once company reach that level of being a dividend aristocrat, a dividend king, they will make sure everything they can possibly do to maintain that, right? Because if they were to start cutting the dividend or reducing it, they would fall out of this prestigious club of high and consistent dividend payers. So obviously, they have a keen interest to continue doing just that. Now, I want to share with you a free tool that you can use to really visualize the power of dividend investing. So let's head over to matchmybroker.com. I'll have a link down in the description below where you find the dividend investing calculator. It's totally free of charge and you can run your own numbers afterwards to kind of visualize of how much dividends you can be expecting towards the end of your investing journey. Otherwise, it's just a theoretical exercise, but I always like to see what value could I be expecting in the future if I was to stick with it. Now, first of all, obviously, you want to choose your currency between euros, dollars, what have you. So let's go with euros for this example. Then you're going to put here your starting value. And again, if you're just starting off investing at all, it might be 0. If you have some of it already in here, you might put the number. But for this example, let's start with 0. We're starting off fresh, or maybe you invested in some other things, but nothing into dividend paying companies first. So let's start off really with 0, with a clean slate. And yeah, I think it makes it more relatable for a lot of people. Then we talk about monthly contribution. And obviously, that depends on you, how much you can afford. In the beginning of your career, obviously, that amount might be smaller, right? Maybe you can only invest 50 euros, 100 euros, 200 euros. It doesn't matter, right? And don't compare yourself to other people. When I started off, I had literally no money to invest, then a little bit, and it grew year over year as I progressed through my career and now run my own business. Obviously, I have larger amounts to invest than I previously had. So it's really up to you. Run your own numbers. But again, let's make it more relatable. Start off with 500 euros a month, and I'll come back to this in a second to switch it to a high amount to show you the impact it has on your total returns. Then we talk about annual dividend yield, and that's the percentage that you expect your companies to pay you in yield. Now, you can choose to invest in high-yielding companies such as Altria. I used to actually invest in this company, and that's a smoking company, a tobacco company that pays you now 7.14%. So really very attractive. But it also means their share price really hasn't done much over a 10-year period. It only grew by 8%. Really, it kind of moved sideways, right? So you get more dividend return, but not so much share appreciation. So that's just something to keep in mind. While Coca-Cola would return you around 2.5%. So let's go with something a bit more conservative. I think 3.5% you could easily find in quite a lot of dividend paying companies out there. Now, dividend growth, I've also shown you that before. In Coca-Cola, that was around 4%. In the case of Altria, it's also 4%. So I think 4% is a realistic number to achieve how they grow their dividends over time. Again, that's not a guarantee. It's just an assumption for this calculation. Share price growth over time. Now, that's a bit more tricky. In the case of Altria, over a 10-year period, basically at 8%, that's less than 1% per year technically, right? While some other companies, they do better. If I go back once again to Coca-Cola, I mean, let's see, over a 10-year period, they grew by 74%. So let's be a little bit conservative. Again, I would just go with 4% because that way I can add up 4 and 3.5%. So a total return of 7.5%, which does seem realistic because that's slightly less than the S&P 500 that returned historically anywhere from 8 to 10% over the last 30 years. So I would assume most dividend-paying companies to slightly underperform. But of course, instead, you'll get passive income, which, as we talked about, is quite valuable for a lot of investors. Then the time horizon, in this case, let's go with the longer time horizon of 30 years. Obviously, the longer you invest, the more returns on compounding you will benefit from. But for the sake of the exercise, let's leave it at 30 years. Annual growth contribution, right? That's also really important. Not a lot of calculators actually have that because, as I mentioned right now, maybe you can only afford to invest 500 or less even, right? But going forward, over a 30-year period, naturally, hopefully, you will earn more money, you have promotions and what have you to invest more in the future. So here you would place your estimated percentage growth over time. So if you assume every year you get a salary increase of, 2%, 5%, 10%, 10% might not be sustainable for 30 years consistently. So I would say, anywhere from 3 to 5% you can go with. Let's go with 4% in this example. But again, you can try different numbers just to see what works. For dividend tax rate, that again depends on which country you're watching this from. If you're like me right now in the UAE, well, then it would be a big fat 0, which is nice. But if you're based somewhere else, again, it might be a higher percentage, 15%, whatever it is. Obviously have a look, jump on ChatGPT, ask what is your dividend tax rate, and then plug it in here. And the dividend frequency. Is it paid out to you monthly, quarterly, or annually? Again, some companies, they pay out on an annual basis, mostly European companies, usually annually. Most US dividend paying companies, they pay out on a quarterly basis, such as Coca-Cola and Altria, but some of them are also paying on a monthly basis. For example, Realty Income, very popular company for people to invest in. As you can see over here, paid out monthly. and the annual dividend yield is 5.64%. And lastly, you can choose whether you want to reinvest the dividends or not. Some brokers allow you to automatically reinvest any dividend that's paid to you into buying more shares, and you can choose whether you want to do it, yes or no. If you invest for the long term, I would definitely say have it. You want to reinvest right away the dividend. So let's say you get paid a dividend of 1,000 euros, right? Instead of just paying it out to yourself and living from it, you automatically right then, right there, reinvest and buy more shares with it, because that will help you to grow your portfolio even faster in the future. So with those numbers plugged in, you will have after 30 years a portfolio value of 1.7 million euros. Not too shabby, right? For a small amount that you invest actually. So definitely quite attractive. And the cool thing is, in the last year or the 30th year after doing that, you will have an annual dividend payment to you of 138,000 euros per year. So that's more than 10,000 euros a month paid to you in dividends. So that's really quite attractive, and most people can actually live from that. Now, obviously, you're also going to have inflation, right? So, 100,000 euros today are different than 100,000 euros in 30 years from now. It might be worth much less, but still, it's definitely going to be a quite attractive amount. And personally, I think much more reliable to depend on that than most pensions you can be expecting from your respective countries. And over the whole period, the total dividends earned will be 855,000 euros. So a major amount, close to 1 million, only in dividends. So that's a major part. You can see here, obviously, visualized how that developed. And that's the power of compounding interest, right? The longer you invested, the more you'll benefit from it. Because in the beginning, it's very, very little, right? I mean, look, even after, 10 years here, your dividend income will only be around 4,000 euros. Absolutely nothing. But if you stay invested over time, it will really balloon. Now, as I said, let's go back and change just one parameter of this equation, your monthly contribution. If you can manage to shell out 1,000 euros, which I know for some of you watching might seem like a lot, while for others, it might be absolute pocket change, right? So it really depends on the situation. But just to show you the power of compound growth, not linear growth, but compound growth over time. Now, all of a sudden, your final portfolio value is already at 3.4 million euros, and the final annual dividend will be 276,000 euros, more than 250,000 in 1 year paid to you just in dividends. So unbelievable numbers. All right, and let's do one last change. The annual dividend yield, let's go a bit more aggressive to 4%. The rest will leave. And the annual contribution growth, I want to go to 5% actually. And now you'll see your final portfolio value, almost 4.5 million euros. And final annual dividend, 407,000 euros in 1 year alone. Just absolutely crazy numbers. I think most of us will be very, very happy with such a number, purely paid to you for being a shareholder in the company. I mean, it's absolutely amazing. And once again, time in the market just beats timing the market. But you see how those small numbers over time really start compounding and snowballing into a major number. So check out the calculator, run your own numbers, and you'll be amazed of where your portfolio could be in the future if you stick with it over time. The beauty of dividend investing is you don't have to panic, right? Even when the markets are down, your dividends are coming in, they're being paid to you. And that's the beauty of it. You don't have to worry, you don't have to follow the markets constantly, because you know your passive income will be paid to you if you were to invest in dividend king companies such as those ones over here. Quite a few of them out there that have been paying dividends and growing the dividends for so long. Obviously, it's not a guarantee, but you have a very solid track record and history of paying those dividends, so you definitely have less to worry about. But let's also talk about the risk, because dividend investing isn't exactly bulletproof either. And that's because dividends are not guaranteed. Companies can and they do cut them. Just because Coca-Cola has a great track record doesn't mean that they will never cut it. And also many other dividend paying stocks have cut their dividends in the past. In fact, if you only rely on dividends to fund your retirement, you're still exposed. Just a couple of companies slashing and cutting the dividends and your income is compromised. And this can be really painful when you rely on the dividend to pay your living expenses. And the challenge is that you also end up picking individual companies to invest in. And that comes with all the usual stock picking risks. So is it wise to build your entire financial future on dividends alone? Well, probably not. With this, let me share with you my personal strategy and where I stand on the topic of dividends. Personally, I used to be a more active dividend investor. I love the stability, the payout, seeing your growth months after months the more you invest, and I still appreciate it to this very day. In fact, I still technically collect some dividends passively through my S&P 500 ETF. That's the ETF that I'm investing in, the SPY5, not investing advice, it's just the one I chose. And if I click on dividends over here, you can see right now it's around 1.14%. So currently it pays me every quarter between $200 and $300, which obviously is not life-changing money, but still appreciated little cash injection, which hopefully continues to grow over time. And I will of course reinvest that amount immediately to make sure I get even more shares in that ETF. However, I have shifted. These days, I focus more on total returns. Why? Because I want to really maximize long-term growth of my portfolio. And total returns is basically taking the dividend return plus the actual share price appreciation over time, not only focusing on dividend returns, but really total returns. Because the problem is with a lot of dividend paying companies, they're so focused on the dividends itself that they neglect the actual share price appreciation, as we've seen just an example of Altria that really hasn't moved anywhere and you only benefited from the dividend, which is not a bad thing, but it's just something to keep in mind. And I prefer looking at the total returns versus the S&P 500. So while I do appreciate dividends and I think they can have a place in a lot of investors' portfolio, ultimately it depends on what kind of investor you're in. Personally, I don't want to depend on just one income source when I get old. But when I think personally about retirement or just financial independence, I think about layers such as dividends, rental income, business income from different businesses that still be running even when I'm old, maybe it passed on, royalties, interest. So different layers that really come together, not just one in the form of dividends. I really value cash flow from different sources. So summing it all up, dividend investing is really powerful. It rewards long-term behavior, it generates passive income, and adds stability to your portfolio. But it certainly is not magic. It's not risk-free, and it's not the only path to financial freedom. So whether you're already a dividend investor or you plan to become one, or you don't like dividends at all, I hope this video opened up your mind to just show you that dividend investing is just yet another tool and path and strategy to invest, because there's not one best way to invest. Ultimately, it has to work for you, right? If you want less stress without the market volatility, the ups and downs, then dividend investing can be great, right? If you only look at total returns and you have 30, 40 years to invest and you plan to have other businesses on the side, well, then maybe it's not that attractive after all, right? There's no black and white answer for everyone, but I really do think that dividend investing can be part of many investors' strategies. Next up, check out this video here. As always, thanks for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.